Which is better, 401k or IRA? I'd like to say it depends, but almost always the answer is 401k, and specifically a solo 401k.
This presentation is for educational purposes only. American IRA, headquartered in Sioux Falls, South Dakota, is a neutral third-party administrator on behalf of the custodian New Vision Trust Company, a state-chartered trust company based in South Dakota also, and does not offer investment advice or endorsements. We are not responsible for statements made by others, and references to we and us refer to American IRA only. We encourage you to do your own due diligence and consult with qualified professionals before making any investment decisions. Hi, good afternoon, everyone, and welcome to another presentation of the IRA Cafe, powered by American IRA. I'm Kyle Moody with the business development team here, and we are so glad that you have joined us. If this is your first time joining us on one of these presentations, welcome. And if you've been here before and you're sharpening the saw and getting some more education, then welcome back. And always remember, too, that not just are you able to see us live here today, but if there's some information that you just, want to make sure that you heard correctly or want to hear it again, anyone who did register is always going to be able to receive the rebroadcast that we will email out to you. Not going to do a long introduction today here on this side because there's a lot of information coming your way from our guest. But here at American IRA, you know that we specialize in self-directed IRAs and solo 401ks. And so for anyone who is looking to maybe diversify out of a current portfolio that they have with a traditional IRA or a Roth or even a solo 401k elsewhere that you're managing yourself, always know that you can take those same funds and put those into a true self-directed retirement account where you have even more control over your investment objectives. So instead of the stocks, bonds, and mutual funds that you might be used to investing in, then you can now take those same monies and invest in real estate or be a private money lender, get into syndication, private equity deals, or even precious metals. Anything like that, you can always research on our website at AmericanIRA.com, and feel free to call any of us on the business development team. We're here to answer any of your questions and get you on your investment journey. Without further delay, one thing that you've always heard us talk about throughout the year on these presentations or any questions that folks have are the different account types and what you can do with them, whether it's going to be a traditional IRA, a Roth account, or even for those folks that have their own business with no full-time employees, the most powerful retirement vehicle out there, the solo 401k. So we talked to you about the different accounts and we talked to you about all the different strategies as well. But the one thing you will always hear me talk about, whether it is out at an event, on stage, or even a call, and especially right here, we're not fiduciaries. So I'm not permitted to give any tax, financial, or legal advice, suggestions, or opinions. And you are always encouraged to speak to your tax or legal professional. Well, guess what today, folks? You're in luck because we have both. Not only are you going to be learning some more information on the different strategies out there, and not only the investment strategies, but the tax strategies, but you're going to be getting it from the trusted tax professional. Today, we're joined by Keith Blackborg. He is a CPA and the founder of Financial Journey. And we are so happy to have you here with us, Keith. And not only today, but this is actually launching a series that we are doing with Keith and his team. And this is actually going to take us through presentations all the way through March of 2026. So don't just stop here and watch this one. Make sure that you check back in and that you join us for all the other future events that Keith is going to be teaching us today. So Keith, thank you so much for joining us. We're looking forward to today and all the presentations coming forward. So without further ado, I'm turning it over to you, and we're looking forward to a good presentation.
Thank you, Kyle. Thanks for having me. So today, jumping straight in, we get to talk about core concepts and advanced strategies to really make the most of your retirement accounts at American IRA. Standard disclaimer, we're going to shorten this and say if you need professional help, get it. I am a CPA, owned a tax firm. My partner on the tax side of things is a tax attorney. and we will specialize on IRA tax matters. And so if you need help, happy to help. So let's just start with the super basics, and then we're going to build and get more advanced from there. So first and foremost, what is a traditional retirement account? It's typically when contributions are put in, you get a tax deduction. When distributions come out, that's creating a taxable event. So when I say traditional, I mean pre-tax funds that could be possibly later rolled to a Roth. And we're going to talk a little bit about a 401k. What's the power of legally avoiding and paying tax? Well, it really becomes clearer as you move on and use these strategies. And so with a Roth, there is no tax deduction with your contributions, and there's no taxable event when those come out. So post tax, those funds can also be called post tax funds, and that under current law they are never taxed again. So a Roth means over the course of your lifetime, 2 to 5x, depending on how long you're holding, in more compounding over your lifetime, meaning you don't have the IRS taking 20 or 30% of your earnings of your nest egg every single year through taxes. Roth means it's able to grow more over time. And so one of the concepts that sometimes people miss is you've got IRAs and 401ks. And then you've got traditional versus Roth, and there's all combinations of all those. You can have traditional IRA, traditional 401k, Roth IRA, and the Roth 401k. And to be clear, you can roll money from a traditional IRA to a traditional 401k, and then you can roll either to a Roth 401k or a Roth IRA. You can move money from a Roth 401k to a Roth IRA. What you can't do is once something is in a Roth IRA, you can't move it out. That's where you're somewhat in IRA jail. I don't know if that's the right answer. You can still spend it, you can still use it. You just can't move it back to a Roth 401k at any point in time. And that point is important, as you'll see later. And talking the difference between traditional versus 401k, would you rather pay taxes on the seed or the harvest? Often, if you're able to pay the taxes early and you expect to grow and your income to grow over time, often the Roth is better. Here's some general rules of thumb to help you make those decisions. So under age 40, generally it makes sense to do more Roth. You've got more time for your money to compound as tax-free growth. And often, especially in your 20s, you're at a lower tax bracket. When you start getting your 30s and 40s, you're more likely to be at the height of your earning potential, and you're likely to be hitting newer and higher tax brackets. Age 40 to 50, do I do the rollover? Typically, it's a gray area, and so you've really got to pay attention to your tax brackets. If you happen to have a year where you've got lower tax brackets, I'd be more likely to do the 401k. Over age 50, I'm more likely to suggest just do traditional, because if you do that rollover and you pay more in taxes, you're likely to be paying taxes at a higher tax bracket, and you've got much less time to make up the difference in terms of growth and compounding within your Roth. And so obviously the answer can always be it depends on your personal situation, but here's some general rules of thought. Now we'll talk about discounted rollovers later. Those are the exception. Those are nearly always a good idea to do if you can roll money at a big discount. Now, which is better, 401k or IRA? I'd like to say it depends, but almost always the answer is 401k, and specifically a solo 401k. So let me give some examples why. You can now put in about $70,000 in traditional funds now, and then that can grow, especially if you're 50 plus. You can add another $7,500 to that. Let's say versus an IRA, you're putting in 7,000, like a tenth of what you could be putting in if you've got a 401k. And I also, small point, you can have a 401k through your employer. You can also have a separate 401k through your own individual account. Now, separate control groups won't go into that technicality, but as long as there's different ownership on who's paying or responsible for that 401k, generally, loosely, you can have two 401k accounts. And there's some people that get really creative in having multiple 401k accounts. Now, I will say, if you're doing an IRA, and let's say you're investing, and maybe you're even using it to flip houses or do real estate, something where you've got more personal involvement. If you were to make a mistake or it's a prohibited transaction, let's say you've got $1 million in that IRA, and you make $100,000 investment in something that's declared a prohibited transaction, the IRS is going to distribute the entire account. You're going to lose, once we factor in taxes and penalties, about 90% of your account balance due to that IRA failure, that prohibited transaction. So you lose about $900,000 in that example. Let's say we were to do that same $100,000 deals within your 401k, the IRS is much more forgiving. You lose about 15% of your $100,000, which is $15,000 penalty versus $900,000 in that example. Very big difference. Now, they both have UBIT, unrelated business income tax. I'll go into greater depth on what that is and how to avoid that in later webinars with this series. But for now, if you invest in an active business like a restaurant, a golf course, standard services-based businesses, unless there's some specific things you do differently, generally it's going to be subject to UBIT, which means you're going to pay taxes at the highest tax bracket of about 37%. You actually have to file a tax return for your retirement account. It's not fun, a 990T, but there's ways to avoid another kind of tax that's related to that. So they both pay that UBIT. Now, the big difference for a lot of people on this is, I know a lot of people like to invest in real estate syndications, meaning you're putting money into somebody else's apartment deal, some sort of commercial real estate, maybe rental houses. Typically, when we're buying an apartment complex, we're using leverage. Maybe 70, 80% of the purchase price is financed by a third-party lender like Fannie, Freddie type loans. And so let's say 80% of your purchase price is financed by a third-party lender. It's typical in real estate that 80% of your income is now subject to UBIT through unrelated debt financed income if it's in an IRA. If you do that exact same transaction from a 401k, it's statutorily exempt from UDFI. Another win for a 401k. With a 401k, you can also you can do the $50,000 personal loan if you need to pull money out. And with IRA, typically you need 59 and a half to pull money out without penalty. There's always some exceptions. But with a 401k, you can pull it out without penalty at age 55 if you get fired. So one of the ways this sometimes works is maybe you have two spouses in the business and one spouse fires the other spouse. And now suddenly they've got freed up assets to live off that spouse's retirement account. And if you're working together, that can work really nicely. And then also your inherited accounts under like the 401k can be convertible, whereas you don't have the same options with an inherited account. So what does it require to have a solo 401k? First and foremost, you need to have a business. How do you get a business? Well, it needs to be a business, but it could start with just having $1,000 or $1 worth of income that you're really trying to make a business work. So that could be underwater basket weaving or anything else that you think is creative. You just need a business. The moment you have that business, now we can do a rollover of your existing IRA or 401k funds from another job or a place of employment. And now you've got something in there. You can also make contributions, but it's limited to 100% of the business's net income. So the business makes a net $100,000. You can a net $1,000. Then you can put $1,000 into that retirement account. So for a lot of people, unless they have a larger business that's really pulling in income, at least doing the rollovers is a great advantage here. And solo does mean you and your spouse. To truly have a solo 401k, you can't have your kids employed. Sometimes there are some workarounds, but that's going to be beyond the scope of today. The point is, you and your spouse can do this together, and as the only two employees of this business. If you have a business with employees, sometimes there are certain structures that can allow you to do it with employees, but that's a more advanced setup and a non-safe harbor plan. It's typically custom written for your business. So when do you want to upgrade from a solo 401k? It's typically when you hire employees, when you hire children. That's when we're talking some of the more advanced things. Or sometimes you may decide not to hire people directly in the business. Maybe you're doing third-party contractors instead, and then you don't truly have employees. So there's a number of things to think through. I'd ask you to speak to your tax professional. You can speak to us, but really in thinking through some of these issues. And so now we're going to shift to some of the more advanced topics and mastering the magic of Roth accounts. So let's talk about the mega Roth 401k. So let's say you were to put $23,500 as a pre-tax contribution as an employee. You're then putting another $7,500 as the catch-up. So you're getting $30,000. We've also got the $46,000 in after-tax contributions, which is its own category, but it really means that money is going to get rolled directly to the Roth. Allows you to put in a max of $70,000 here in 2025, or if you're over 50, $77,500. And the point is, if you're putting in $77,500, you've got to have a higher salary amount to help justify that. And those amounts are per spouse or per employee associated with this. So you would each need to be, if you've got, like a lot of people have an LLC taxed as an S corp for the business, you would need to be paying each other both a wage to justify that. For me, I found somewhere around $30,000, $40,000 in salary is a great way to max out at least that pre-tax contribution and really grow that part. If my primary goal of paying myself a salary is to max out the contributions. I'll be doing a more advanced webinar with AmericanIRA later on how to specifically work through the contributions. There's a whole math and science to it, a little bit of an art. And so we'll be talking through the exact hows for those that are really just that curious. So one example is, how do I pay myself? So I might give myself one large check for $31,333. Why that specific amount? Because I can do that in Q1. So let's say here in 2025, you really want to take advantage of that concept. You could reach out to Kyle, say, Kyle, I want my solo 401k. You're going to make a big contribution and set up your plan before December 31st of this year. You're putting in $70-something thousand, or maybe it's just the pre-tax limit of about $30,000. You're putting in at least $30,000. And then January 1st rolls around, you cut yourself that early paycheck and you put in another $30,000 for 2026. And so between the two of them, now you've got $60,000, which is a good amount to go place into a private investment or syndication. For me personally, I get to the end of the year, I've made my initial contribution in Q1 of that year just to get my account funded and start investing and growing it in that tax deferred account. And then I reach the end of the year and I don't personally do federal withholding. I instead give myself a big paycheck at the end of the year, and virtually all my wages go towards my federal income tax. And it's kind of a trick to avoid making quarterly payments and just making a big payment at the end of the year. And so I get to catch up with all my accounting, know what my tax bill is. And then by paying it through the W-2, it's not like I've missed out on any underpayment penalties. So I'll leave this slide up here for just a moment for those that want to pause and look at this and think through how they might do this. Happy to help as a CPA firm if you're more curious about how we do this. So the power of a self-directed retirement account by working with AmericanIRA is you can invest in almost anything, including real estate, private lending, cryptocurrency, private businesses, traditional brokerages. There are ways to structure even private business investments where there is no UBIT. We'll talk through some of those advanced structures on another webinar, specifically UBIT. So more to look forward to. But you can really invest in anything, which means you can put some of the best, fastest growing assets out there inside your retirement account and really take advantage of the opportunities. That's the power of doing a self-directed account through somebody like American IRA. One of the things, there's a couple options in how we think through things. One, you can do custodian control, where they control the bank account. They're more responsible for the accounting. And depending on the provider, they may be responsible for the tax filings. They're your driver. Sometimes their fees aren't that high, but sometimes there can be more fees associated if you're cutting a lot of checks, but they're in control. There's more safety in being able to work with somebody who's doing it for you because they've got the driving license in this example and have done it before. There's checkbook control. There's more freedom. You can do it. You can do your own transactions. And some people really like that. But you're also responsible for the accounting, and you're more likely to be responsible for all the tax filings and things that come up with it. And so some people might try and save a couple bucks that way. Truly up to you. But you've got to be more aware of what you're doing, and the guardrails, so to speak, are off. Now, let's say you've got a traditional IRA, a Roth, maybe your spouse has that, maybe your kids have retirement accounts, maybe you have an HSA. A lot of those can wind up with small balances between $5,000 and $50,000, and it can be tough to deploy that in private assets, where often the minimum check size is $50,000. So what do you do with all these small accounts, and how do you effectively deploy them? One of my favorite ways to handle this is you set up a single asset holding company. And in Texas, where I am, you can do a series LLC that actually has multiple companies underneath it, but you just file one tax return. That way you've got different limited liability. But frankly, if you're using just like a checkbook LLC or anything like that, where it's just a single investment company, that single company can then go invest in all these different things. And your wife's HSA, IRA, your spouse's retirement accounts, your kids, if maybe you started them young with a retirement account that they're also going to use for their college possibly, all those accounts can invest together. Now you've got a single entity that's going out and making these investments. I will say you've got to keep up with your accounting and know what came from what, but a savvy bookkeeper can keep up with this. And for me, this is something that really makes a big difference. We'll talk through this in more detail in an upcoming webinar on entity structures. One of the things that I'll introduce here is if you've got an LLC taxed as a C Corp, you can still do investments through that C Corp. And that way the C Corp pays the taxes at 21%. And then it issues dividends back to your IRA. There's no more UBIT. Just like investing in a publicly traded company, as long as another entity has paid the tax, we now shift our tax bracket from 37% at the UBIT IRA tax level down to 21%. So that's a 16% difference, which is really significant. What are some other ways that people grow their financial accounts quickly? And so I know some people that are financial friends, and so they will work together where I can't, let's say I have a hard money lending company or wholesaling company, or I'm doing flips on the side. I can't do transactions directly between myself and my retirement account. But maybe I meet somebody who is also a flipper and is also a wholesaler or doing deals. Basically, you're both finding rental houses, and you were to discover that you both have a fantastic wholesale deal, and you would love to do that kind of a wholesale deal or flip inside your retirement account. Well, to sell it to your IRA would be a prohibited transaction. But maybe instead, that friend buys a wholesale deal from you, makes a good profit from you helping them find a particularly good deal, and then months later, they help you find a similar deal. So this is a great way if you've built some trust. There's not usually something formal here, but it's a way that I've seen some people who have grown a Roth account over time to 2 million plus. as part of that. Debt leverage. Some banks will specialize in lending to retirement accounts. I'm going to mention it here. Typically, it's more expensive, like 8 to 10%. You can't ever personally guarantee your debt, but that debt leverage, if you really want to buy a rental house, can be really valuable in a time of need. Rollover business startup. So earlier I talked about how you can't do business with yourself. You can't own a business in your retirement account that you run and control, where you're providing personal services to, without it being a prohibited transaction. The exemption here is a rollover business startup, and this is a special account that's set up to run a business like that. So think of like REI, the sports store, or certain co-ops, like maybe grocery stores, where the employees have been permitted to use their employer retirement accounts to invest back in the business. This is where this was originally designed. It came around in, I think it was 1971. It was in the early 70s. So it's been around for a long time. It just hasn't been marketed much. And so this is a way for your business to actually run and operate a business within, ideally, a Roth 401k, and to have a lot of growth, all that profit, or a lot of that profit, going back to the retirement account. And you can decide it's 50% owned by the retirement account, 95% owned by the retirement account. You can do what version of that you'd like. So you're getting some money personally, and you're also able to grow. So with some of these advanced strategies, it's a way to make a big difference to your retirement account. Discounted rollover. So this is one of my favorite tools to make a big impact quickly. So let's say you had $100,000 that you wanted to invest in a hotel to apartment conversion. And day one, we're buying an operating hotel with another operator. And the whole plan is to convert that to an apartment complex. But to get it to an apartment complex, we've got to shut it down and renovate it. So day two, we shut down an operating hotel. What is a shutdown hotel worth? A whole lot less than the operating hotel is that you paid for. Risk is higher. There's a chance of things not going well. And so at least on paper, that value has decreased temporarily. So let's say you invested $100,000. We're going out, hiring a third-party appraiser. For those familiar with estate planning, you might know lack of marketability, lack of control discount. And often we're getting a 50 to 60% discount legitimately. And now we're doing a rollover of the asset, not the cash, at maybe $50,000. We're paying taxes on the $50,000. We're getting a 1099-R, all of that. And now all that growth happens in the Roth account. So when that deal reopens as an apartment complex, now maybe you have $200,000 within the Roth. So that's a big shift for people to be able to strategically move money over. So backing up, thinking through what that meant from your personal side, you got a $100,000 tax deduction as you put money into your traditional account over time. Then you received $50,000 in taxable income. Not fun, but you're still ahead by $50,000 in that example. And then you've got $200,000 taxed within a Roth that's never taxed again. So with some smart planning and aligning your investment strategy with your tax strategy, you can really make a big difference. And so that's the main thing I do now, is really discounted rollovers, is providing this service to folks. And so we find good deals that we feel good about it with third-party operators, and then we'll come in and do the valuation to make all of that happen. I'm going to open it up to questions. If you have any questions about this, you want the slides, feel free to scan the QR code. If you happen to be in the Dallas area, October 23rd, 24th, passiveinvestorevent.com. I'm hosting an event for investors where we'll talk through strategies and other investments like these. Otherwise, I hope to see you guys on an upcoming webinar. How much do you want to contribute to your retirement accounts? Often you need to have your account set up before the end of the year for that really to make a difference, especially with the 401ks. The IRAs, you've got a little more flexibility, but the 401ks at $70,000 per spouse really make a difference. And so now's a good time to start thinking about that, looking at what funds you have available. And even if you can't contribute in 2025, set up the solo 401k in 2025, and you can still follow up with the contributions by the tax filing deadline, April 15th. You can still be contributing to your IRAs and such. And so getting ahead of that really makes a difference.
Gotcha. No, great stuff there. And as he's talking about what's coming up, at the turn of the year, one thing that you do need to think about really before it gets here, and we close up shop on early on December the 31st, is the solo 401k. You heard him talk about it and how it needs to be established by the end of the year. And you need to have your thoughts already together on your contributions. You're going to hear me break out the specifics of the solo 401k, where we spend some more time on that in our upcoming webinar that we do in-house next Wednesday. So hope that you join us for that one as well. Bring some good questions on that, and we will really break out the solo 401k, which also, if I'm not mistaken, there's going to be some things discussed there that will really tee up other things like the contributions and such that Keith was talking about, that he's going to be covering in later presentations. As you know, we really, though we specialize in your ability to diversify your portfolio, to have a retirement account that you can have a lot more control over, it also coincides with all the education that we make sure that you have, and you're working with the best information possible. Thank you again to our guest, Keith. We're already looking forward to the next part of our series when he's going to be joining us. We'll make sure that you all have the dates and the information of that coming up. And thank you all for joining us today as well, taking some time out of your busy day as well to join us here on another presentation of the IRA Cafe powered by American IRA. I'm Kyle Moody again with the Business Development Department, and for everyone here at American IRA, thanks again, and we'll see you next time.